Well, I originally wanted to talk about Twitter suspending accounts who are too skeptical of NATO or, quote, like undermine, I think was the word they used, NATO, narratives. And maybe I'll have time to get to that at the end, but I mean, the big news today that I cannot avoid is the ongoing bond apocalypse. I was trying to give this a rest because I discussed it, quite a bit over last week and this week. But I mean, we've got the 10-year now up over 1.5%. Bond yields are rocketing higher, and for those who don't know what that means, is that the market is selling U.S. government debt. And in the words of Rick Santelli, today's 7-year Treasury auction, was the worst ever. And what he means by that is that there's very little interest to purchase more U.S. government debt. And this is at a time when the U.S. government is about to ramp up their deficit spending more than ever with the Democrats in office. They're supposed to be now. A lot of people are not buying this anymore since they feel like they've been betrayed by Biden and Harris. But they were supposed to, start handing out checks to more people. They were supposed to hand out $2,000 checks, and you've got this one big $1.9 trillion spending bill, which, $1 trillion used to be a lot of money to the U.S. government. Back when George Bush was president, I think we had something like a $4 trillion deficit, but I'm pretty sure that was before 9/11. Now the government just regularly issues multi-trillion-dollar deficit bills. That was a word salad. Forgive me there. What I mean to say is that we have entire bills that are paid entirely through deficit spending, like this $1.9 trillion bill. There's nothing for that. There's no money for that in the regular government budget. Based on tax receipts. They're not taxing $1.9 trillion from the American people and to redistribute that. No, they're issuing $1.9 trillion in debt. This is on top of everything that the government already spends. It's not like they're cutting the military and Medicaid or something in order to give people free checks. And it's also worth noting that the no longer $2,000 checks, the $1,400 checks, they represent a very small fraction of that 1.9 trillion. And so if I'm someone who's looking at investing in U.S. government debt, I would have to think, people are not going to be satisfied by this 1.9 trillion. Not only is it a massive amount of debt that the federal government is about to issue, but they're going to have to issue a lot more in order to satisfy their constituents. And so when you have, U.S. government debt that is yielding a negative rate of interest, does that really look like that attractive of an asset to you? Jerome Powell says that he's targeting an inflation rate of 2%. And if the 10-year Treasury bond, for example, is trading right now at 1.5%, you're getting a negative 0.5% rate of interest, and that's if the Fed is telling the truth about the rate of inflation, which, dirty little secret, everybody knows that they're not. So if you're going to issue so many more of these securities, who is there that's interested in buying them at the current price? What we saw today with the 7-year auction is a glimpse into the future. Interest in U.S. Treasury bonds is already waning. And so if on top of that, if you take a decreasing demand and you add into that an increasing supply, what do you end up with? You end up with lower prices. It's basic supply and demand. And so the long and the short of it is that interest rates must rise, and they're going to continue rising higher. I've explained this before, and I won't go into too much depth about it. But the Fed today, they sent Bostich out, who is I forget which. He's not St. Louis. Bostich might be Philly. He might be the president of the Philly Fed. But anyway, he was out there toting, the Fed's line, saying that we're not worried about these yields. They're not getting high. No, these yields are really low, trying to convince, trying to I guess, bolster investor sentiment, to try and advertise or pitch treasury bonds to Wall Street, and people were not buying it. Now, the ridiculous narrative to explain all this, coming from your mainstream financial press, is that, well, the bond market is just anticipating such high economic growth in the future. And that's why they're bidding yields up, because you see all of these guys who would be spending money buying up treasury bonds, they're now looking to invest that in the private sector, to invest in companies that are going to grow, because we're going to have a bunch of economic growth. There's all this pent-up demand, don't you know, because of the lockdowns last year, and now, in 2021, everything's going to be so different, and there's going to be all this growth that's going to be unleashed. But if that were the case, you would be witnessing a rotation from treasury bonds into growth stocks. But instead, we are seeing a rotation out of both stocks and bonds and into just about nothing. Today was the worst day for risk parity funds in probably, I think, since March. Which, of course, March is when the big crash was last year, before the Fed came in and put a bottom in the market. And for those who don't know, risk parity tries to balance, the stability but low returns that you get in the bond market with the high risk but high return that you get from the stock market. It tries to, get you an average, level of risk that's between the two. I think the general formula is like 2/3 bonds to 1/3 stocks. The idea being that you have 1/3 of your money in something that is risky, that you might lose a bit of money sometimes, but is going to get you much higher rate of return on your investment, and you have 2/3 of your money in assets that are fairly stable. That's the logic behind risk parity, and it's also sort of based off the idea that, well, if one of those two asset classes is doing well, it's going to be at the expense of the other. So you're always riding the wave somehow. If stocks are doing well, bonds are going to be doing, or that's going to hurt bonds to a certain extent, or blunt the momentum of bonds. And the same is true if stocks are doing bad, people are going to be buying bonds. So you can kind of you can try and ride the storm a little better. Essentially you've hedged. But when both stocks and bonds fall, then risk parity obviously is going to get creamed. And even in recent days, the stocks that have been doing well for the most part have been your value stocks. They haven't been your growth stocks. And so I just don't see where this argument for sudden renewed economic growth is coming from. To me, it seems pretty clear that Treasury yields are rising. That's going to push up interest rates across the economy, and that, of course, is going to hurt all of these publicly traded companies, because all of these companies, their valuations have been heavily inflated by the Fed, just pumping a bunch of air into the credit markets. These companies have been able to, issue a ton of bonds themselves at very low rates of interest and buy back their own stock. They've been able to, go into debt to expand their business beyond really where they should, beyond points that are sustainable. And of course, ultra low interest rates just drive people into the stock market in general, because there is no other alternative. And so when interest rates rise, it's bad for bonds. Actually, I shouldn't say that. Interest rates are rising because bonds are doing badly. And I'll get into that in a second. But then, of course, it's bad when interest rates rise. It's bad for stocks. It's bad for business. It's bad for our economy, even though, as Bostich points out, interest rates are historically low. Obviously, 1.5% for a 10-year bond, that's ridiculous. That's below, that's a negative real yield. We have a fake economy that's built entirely on cheap, easy money. And so our economy can only keep growing if the Fed keeps injecting, ever greater amounts of stimulus to sort of pump up and energize all of these zombie companies. And, this goes back to, in 2008, the fact that the establishment did not allow the companies that should have failed back then to fail. And so you have all the weight of the 2008 crisis still bearing down on the market, and then you've got all of this extra, underbrush that has just built up over the last decade, or over a decade at this point. And 2008 was 13 years ago. And so low interest rates have, created all this malinvestment, which will not be able to survive, which will not pan out if interest rates rise. The only way that you endure rising interest rates is if the investments that you made, like let's say you take out debt, you go into debt to invest in something, to start a business, for example, and you borrow money at 3%, and your business is only making you a 4% return on that money that you borrowed. That's your rate of return there. Well, that's okay because you spend 3% of that paying back the interest on the debt, and then you have 1% that's profit. But all of a sudden, if your interest rate goes from 3% to 5%, well then you're in the hole. You're no longer running a profitable business. And when central banks artificially suppress interest rates, they create a bunch of these companies and a bunch of these business ventures that otherwise would not exist and otherwise cannot exist. So when rates start to creep back up towards their natural level, these people start to go under. And that leads to a cascading effect, which manifests itself in some form of a financial crisis. And so make no mistake, that is the beginnings of what we may be witnessing. Unabated, a steady rise in interest rates, like we're witnessing right now, will lead to the next financial crisis. And so it's imperative that the Fed, if they want to keep the bubble going for however long, forever I guess, they need to find a way to turn things around. It's not too long ago I was talking to all of you about how the 10-year yield had just hit 1.25%, I think it was. And I was saying, hey, that, or no, maybe it was 1.3%. And I was saying, hey, that's almost 1/3 of the way towards 2%. And 2% is a big number for the 10-year. Because once you hit 2%, well, and what comes after that? 3%. Oh my God, what comes after 3%? 4%. I mean, you get my point. I'm being a little facetious because I'm just counting numbers. But the point here is that if the Fed is firmly in control of the bond market, yields should not be able to rise like this, because the Fed is doing everything they can to keep them low. And so if the Fed is doing everything they can to keep them low, if there comes a time such as this, where rates are rising anyway, the Fed can't do anything about it. Now, I don't think that the Fed is completely tapped out, because they're still trying to act bashful and say, well, we're not concerned about this at all. This is totally normal. This is, they're pretending like they're not losing control. They're trying to act tough. They're saying, this is all according to plan, just as I intended, even though everyone knows that that's not true. So at some point here, the Fed's going to have to get serious and try to smash yields back down. And I don't know what they'll do in that case, how they'll go about doing that. I mean, what people have been talking about is they'll go back to yield curve control back, like they had in World War II. But, I mean, practically speaking, how would that be much different from what they're doing now? Because they're already doing everything they can to suppress yields. The Fed is asserting as much control as they can over the yield curve as possible. So I guess I'll leave things there for today. Maybe I'll get to the NATO story tomorrow, because it is important and I would like to discuss it.